Hi everybody and welcome to Chapter 10. In Chapter 10 we're going to talk about flexible budgets. Flexible budgets, unlike static budgets, which we learned about in Chapter 9, vary depending on the activity level. To give you an example, if we're selling shoes, if we sell 100 pairs of shoes, our revenue is going to be one number. If we sell 200 pairs of shoes, our revenue number is obviously going to be more. That would be a change in activity. So if we created a flexible budget, we would have different scenarios for different levels of activity or output. Therefore, the budget would change based off of how many items we sold or didn't sell. Then, after we created these flexible budgets based off of activity level, we would actually compare the actual results with the flexibility or flexible budgets to create what's called a variance. A variance, while it might sound a little confusing, is just really simply the difference between actual cost and planned cost or budgeted cost. Again, to give you an example, if we were selling shoes and we sold $200,000 worth of shoes in 1 month, but we planned to sell $210,000 worth of shoes, our variance would be $10,000 unfavorable because we didn't sell enough shoes that we had planned to sell. Therefore, that unfavorable variance would help us look into what is causing that variance, whether it's maybe lack of marketing expenses or lack of selling experience of our sales commission people. Something is causing that unfavorable variance, which we would then look into to try to determine why we have an unfavorable variance. So when you see U in the chapter, that stands for unfavorable. When you see F, it stands for favorable. Favorable variances mean you outperformed what you thought you were doing. Unfavorable variances mean that you didn't perform the way you expected to perform. Again, I hope this helps. I look forward to talking to you in Chapter 11.